So now let's take a look at the details about this particular result, right? This particular result. But before we look at the codes, let's go through this disclaimer again. All examples and code presented in any of my YouTube videos are technical and illustrative in nature and do not represent any financial recommendation or investment advice. The first thing that we are gonna try to do is to understand what exactly how this particular algorithm actually makes money, right? How this particular algorithm actually makes money. So what I'm saying is that this neural network is trying to make predictions about the direction of the price movement in the next day, right? So for every day in our training data set, we are going to actually try to predict the direction of the price movement the next day, right? The next day. So why do I say that, right? Why do I say that? Because all you have to do is to look at what's actually used as the label, right? What's actually used as the label. What was actually the label? The label was this DFDR, this line of code, right? So if the return is larger than 0, then the label value is going to be 1, right? Otherwise, it's going to be 0, right? What we're saying when we are actually writing this piece of code, creative features, is that this actually represents a direct reward, right? We're trying to build something that's called reinforcement learning, right? And reinforcement learning is going to allow us to take into account not only the direct reward but also the delayed reward, right? But for now, we're just using direct reward. And the next day price movement, if it goes down, then it's a positive direct reward, right? But if the price next day goes up, it's a positive reward, right? But if it goes down, it's a negative reward, right? So that's our label, right? The label is purely just the value of either 1 or 0, right? It doesn't actually involve any other different values, right? And the return was computed what? Based upon the closing price. The closing price of today divided by the closing price of next day, right? No, the closing price of next day divided by the closing price of today, right? So that's, and then takes a natural log of it, right? Because the shift to 1 is on the denominator, right? So that was the label. That was the label. So if our prediction is correct, right, and then the curve is going to increase by value, right? Increasing the orange curve is going to increase in value, right? It's going to go up. But if our prediction is wrong, then it's supposed to either go down or stay flat, right? Because the position is going to be 0, right? Just means that we are not actually shorting the market. We are not shorting the market, so it's very likely to go just flat, right, instead of going down, right? Not likely, but it's also possible to go down, right? For example, for example, if our prediction is wrong and the market goes. If our prediction is that the market is going to go up and then in fact the market actually goes down the next day, then we're going to lose money because we're still staying in the market, right? Position is still positive, right? Position is still 1. So it could go up and down, right? But in some of the regions, you sort of see the flat part, right? Why is that flat part, right? Why this part is flat? It actually gives us some indication about the general idea behind this particular strategy. It's some kind of similar to the mean reversion strategy, but it's a kind of upgraded level of a mean reversion strategy, right? So if the market actually goes up too quickly, then the position is going to be 0. So that's why it actually becomes 0, right? Becomes a flat. I mean, no, not 0, right? So it's a mean reversion. It's somehow similar to the mean reversion strategy, right? This kind of very sharp increase is going to cause the position to go to 0, right? So it's exactly a day-to-day prediction, right? You are predicting the next day price movement, right? You are predicting the next day price. So how do I know if my prediction of the next day price movement is correct or not, right? And let's do some evaluation. Let's do some evaluation, right? How many predictions are correct and versus how many predictions were wrong, right? So let's do this thing. Model.evaluate, right? And then it's going to be test normalized codes, and then test DRD, right? That's our label. So what this command is going to show you is actually both the loss function, so the neural network is going to be optimized, right? And then we have a cross entropy. We have a loss function that's defined in terms of the binary cross entropy, right? And then when we actually build the model, we have another thing that's used as the metrics input called accuracy, right? The accuracy basically tells you the number of correct predictions versus the number of wrong predictions. So it's a ratio between so it's not exactly the ratio, but it's actually the percentage of correct predictions, basically, right? That's called accuracy. Right? Let's just look at that and see how what's actually the value, right? Right. So the first value, the loss is going to be about 0.7764. And the first number, it's the loss function. That's the cross entropy, but it's kind of difficult to understand because you don't have a reference. What was the value that you started with, and then how it actually decreased to like 0.7764. You need to plot the entire history of the loss function during the training process to understand how large the value actually is, right? To understand its relative value, right? But this is for testing data, right? The testing data was never exposed to the training process, so that's the loss value, loss function for the testing data. Right? And the second value is actually the accuracy, right? It's the percentage of correct predictions versus all predictions, right? The ratio between correct prediction versus over all the predictions, right? Over all the predictions. How many predictions we are making, right? It's 2 years of predictions, right? That's about so for every year the number of trading days are about 200 something, right? So it's about 500 predictions. So over those 500 predictions, about 51%, 50.8% are correct predictions, right? It's only 51%. It's only 51%, right? 51% looks like a very small percentage, right? If it's purely just random and our prediction is like a random prediction, then it should be 50%, right? 50%, 50%, right? Half and half. But for this particular test data that we never used for training the model, the prediction accuracy is close to 51%. A little bit short of that, but it's close to 51%. Right? It's only like 1% of statistical advantage. Right? We are making the correct prediction, but looks like a very small advantage. Right? But if you actually do the same thing again and again for many times, you will be able to accumulate lots of returns. The final return in the final day of our testing data set was over 5 times, right? That's over 400% of a return, right? And over 400% of the return was caused by this just 1% of advantage in our prediction, right? Looks like a very small statistical advantage, but if you do this kind of thing, repeat the same process for like over 500 times, you can 5 times your money, right? So that's the accuracy, right? That's the accuracy, right? And do you think it's purely just by chance? Maybe, but maybe it's just by chance that it has a one percentage of advantage, right? But I myself don't really believe that because it's the amount of data, the number of data that we're actually making prediction is over 500. It's over 500. That's many days, right? So if you want to there are 4 more ways of testing if the statistical advantage is really robust or not, right? There are 4 more ways of doing that, but just based upon my intuition and based upon the large amount of data that has been used for the testing, I tend to believe that this 51% of accuracy is actually statistically significant, right? It's unlikely to be just purely just by chance, right? So that's the accuracy. That's the accuracy of this model, right? A second thing that I want to point out is about the difference of this particular trading strategy and the 2 moving average strategy, right? The two moving average strategy that we have been sort of working on or using as a comparison in our previous example is some kind of a trend following strategy. It's if you have traded stocks before, you probably know about what's actually momentum trading, right? And this kind of trend following strategy is somehow kind of similar to momentum trading. So it's a trend following technique, right? Because if the short-term moving average is above the long-term moving average, in general, the trend is actually going up, right? So how do you actually make money from this kind of trend following technique, right? You are pretty much just ignoring the day-to-day price fluctuations, right? As long as the trend is going up, as long as the short-term moving average is above the moving average, long-term moving average, you hold on to your stock, right? You hold on to it, but as soon as the direction reverses, you sell out your stock, right? You just close all your long positions, right? So this kind of a strategy is kind of entirely relies upon the direction of the price movement, right? So if you look at this this kind of if the price movement doesn't have a very clear direction, doesn't have a very strong trend, right? Suppose let's look at something else. Let's for example, let's look at Amazon, right? Does it have Amazon on it? Yeah, it's got Amazon, right? If the for example, if the price movement doesn't have a clear direction, then those two moving averages are going to entangle together. You're going to be, if you are following this particular strategy, it's going to, you have to actually go in and out of the stock constantly, right? And every time you go in there and then the trend reverses again, if the moving average crosses again against you, right? If the market actually moves against you, then you could lose money in a very short amount of time, right? Maybe not a lot of money, but every time you get in there and get out there, you could lose some money, right? Because of this kind of oscillation. The market doesn't really have a clear trend for this particular stock, right? So that's one of the problems about those trend following techniques, right? And another problem about this kind of trend following technique is about the return. The return. How much money you can actually make by following the trend, right? The moving average is some kind of delayed indicator. It's by the time it gives you the buy signal, it's kind of already pretty late. The trend has been going on for quite a while, and by the time it gives you the sell signal or the short signal, the market has been, the price has been going down for quite some time. You could have already have a loss already, quite a significant loss, right? One example is to look at this to look at this huge pullback. That's a market crash caused by the pandemic, right? Last year, right? It's around March or something, right? So when did it actually cross? When did it actually cross? For these two moving averages, 60-day and 120-day, the crossing is happens here, right? If you look at the bottom of the price, it's around here. So by the time you get the buy signal, right, you get the buy signal from the two moving averages, the price has already recovered by like a huge amount, right? So you are losing this much of a benefit, this much of a profit, right? That's a large amount of a profit. Maybe I should just use my 20-day moving average and then 60-day moving average, right? Instead of the, right? That could give you a better buy signal. You should buy over here, right? But still, you are losing this part of the profit, right? And what about the loss? What about the loss, right? So that's the crossing. That's giving you the sell signal, right? Giving you the sales signal, but this is right before the pandemic. The pandemic was okay. So the peak before the pandemic was right here, right? And then by the time you get the sales signal, the price has dropped by like a huge amount, right? So this is actually a delayed signal. It's a delayed signal. So there's a certain amount of profit you are going to lose, and then a certain amount of loss that you have to bear if you use this kind of a delayed index, right? So that's why in this particular example we are adopting a different strategy. So it's not really a trend following strategy. It's not really a trend following strategy. It's actually a mean reversion strategy, or some type of mean reversion strategy. See, because in the feature list, I computed the moving average over here, right? But in the feature list that's used for training the network, I never actually used the SMA, the moving average, simple moving average, inside of my feature list. So the simple moving average itself, which carries the trend signal, right, is not really used for training the neural network. What's actually used for training the network was actually the bias, right? The bias is not the simple moving average. It's the difference between the closing price and the simple moving average. It's a deviation from it, right? It's a deviation from it, and that's the bias. So the bias was actually used as one of those features for training the neural network, right? And if the bias is, and I'm actually checking the moving minimum and maximum of those biases, right? So if the bias is too big or too small, then it's gonna take a short position or long position accordingly, right? But what exactly is too big and what exactly is too small, right? It's based upon its own judgment, right? It's based upon its own judgment by going through this training process, right? Going through this training process is just an optimization process in which the weights are going to be automatically adjusted based upon what's actually optimal for using the past data, using the training data, right? So it is some kind of a similar to the mean reversion, but the criteria for deciding what exactly is too much of a deviation or too much of a bias is determined automatically, not automatically by the training process itself, instead of by a kind of a manual adjusted or human decided factor, right? So it's somehow similar to the mean reversion strategy, right? Somehow similar, but it's kind of a more advanced mean reversion, right? And that's the second thing I want to say about this this result, right? And the third thing I want to say about this result is about overfitting. About overfitting. For the testing data, it's 5 times the starting money, right? But what about the training data? What about the training data? It might be worthwhile to also plot the neural network return for the training data, right? So what I'm going to do is to do train position. So basically all I have to do is to copy this part of the code over, right? So instead of a test, I do train. Test normalized train. Normalized, right? And then test ANR, you train ANR, right? And then right, and then train. Oh, come on. It gives me this very long code. Right. So now let's run this piece of code and see what's going to happen. T-train. Where did I? Oh, okay. Typo here. Okay, so now let's look at the training, right? So the training data lasted for like 4 years, right? So started from here, and then the orange curve is again the return from the neural network, right? And then the blue curve is the day-to-day return. That's the buy and hold strategy, right? That's the buy. So for the training data, the actively traded neural network strategy performs far better than the buy and hold strategy, right? But by how much, right? So buy and hold gives you something that's close to 2, but it's less than 2, right? But this active strategy ANR is around 8, right? It's slightly less than 8 might be, right? So this is 4 years. So for 4 years you get a return that's about 8 times, right? So if you actually look at the testing data, that's 2 years. 2 years, you get a return of about 5 times. So more than 5 times, right? So so from this kind of comparison, I would say the overfitting problem is not really that severe for this particular test, for this particular example, right? Right? Do you remember the overfitting problem for the 2 moving average example, right? For the testing data, it was like how large? It was like for the testing data, the return it was 1.3 times the starting money, right? That's actually far worse than the training data, which is actually about 6 times of the starting money, right? But for this neural network implementation, even though it's got more parameters, for the moving average example, you have only 2 adjustable parameters, right? And then the overfitting problem is actually quite severe. And then this neural network implementation has a lot more adjustable parameters. How do I know it's a lot more adjustable parameters, right? So all I have to do is to do this thing, model, model.summary. Then it's going to tell me how many adjustable parameters are used in this very simplistic 2 hidden layer neural network, right? So the total number of parameters is about 10,689. It's exactly 10,689, right? You got 2 hidden layers, 64 each, right? And then the number of parameters is not the number of neurons. It's actually the connections among the neurons, right? And we are using a full connection. It's a dense network, right? We are not actually implementing any of those techniques for combating overfitting problems, right? Later on, we are going to talk about some of the widely used techniques for combating overfitting problem. But in this particular example, we are not really using any of those techniques yet, right? And later on, once we start to work on those regularization problems or implement dropout and regularization techniques, then you're going to see that there are some kind of well-established techniques for combating overfitting. But at least for this particular example, this many trainable parameters, but didn't actually give you too much of an overfitting problem, right? Too much of an overfitting problem. So I would say it's actually a little bit surprising. It's a little bit surprising, right? And I probably need to think about it and see what exactly is the reason for not seeing too much of an overfitting, right? Yeah, I think that's probably enough for this particular video. In the next video, we're gonna, but there are a few directions that we might want to explore, right? One is overfitting, right? Do we want to spend more time to talk about the techniques for combating overfitting, right? Or do we want to move directly to reinforcement learning and see if we can actually come up with a very rough, very simplistic reinforcement learning implementation of a trading bot, right? Its performance might not be ideal, but let's just come up with something that we can improve upon through iterations, right? That's another possible direction for us to actually work on the codes. But that's it for today. And before we end this particular video, let me just go through this disclaimer again. Right? All examples and code presented in any of my YouTube videos are technical and illustrative in nature and do not represent any financial recommendation or investment advice. Thank you.